Australian corporates are facing pressures of global inflation, rising interest rates, and high energy costs. While the Australian consumers led the recovery out of the pandemic, they will now come under pressure as they feel the impact of rising interest rates and falling housing prices, which will slow down their spending. As such, some sectors will face more pressure than others. At the same time, global markets will be more volatile and disrupted. However, the credit quality of most corporates will broadly remain intact. Australian corporate balance sheets are generally strong and therefore able to cushion the impact. Australian corporate issuers' liquidity is also fairly intact. The biggest concern with liquidity are the sub-investment corporates. Mining, health, construction, building material producers and business service sectors are not only facing lower demand but also rising costs pressuring margins. We do not think pressure on the company's ability to manage these costs will dissipate overnight, especially in the inflationary environment. Energy security and sustainability will be a key issue as well. As Australia looks to resolve its energy dilemma, oil and gas prices will remain high, which flows through to elevated energy costs. Labour shortages don't seem to have an overnight fix. A lot of companies are still grappling with labour shortages or having to pay higher wages. We're also watching the impact of rising interest rates. We expect funding pressures will come through more gradually as and when maturities come up. The increase may also not be as great as it appears on face value. If the debt that needs to be refinanced was issued before the period of low interest rates, the differential delta in funding costs may be lower than the movement in official rates.